Welcome back, focused learners. Let's get right into it. Today, we're going to absolutely demystify the somewhat overwhelming world of investing to help you build lasting wealth. Look, if you want to achieve financial freedom and genuinely create a better future for yourself, investing is, without a doubt, one of the most powerful tools you have available. We've distilled all the essential knowledge into this explainer, so get ready. We're going to build your financial house from the ground up. Okay, let's dive into this. It's so common to look at wealthy individuals and just assume, they got a lucky break. But the truth presented in our source material is actually incredibly empowering. Successful investing is not about luck, not at all. Instead, it relies heavily on knowledge, discipline, patience, and just making smart decisions consistently over time. Literally anyone can do this as long as you follow the right blueprint. So you might be wondering, if it's not about luck, why isn't everyone doing it? Well, many beginners are completely paralyzed because they simply don't know where to start. They don't know which investments to choose, and honestly, they're terrified of making costly mistakes that might set them back. Consider this explainer your ultimate roadmap to bypassing those exact fears. Here is exactly how we'll break it down. 1. Your financial foundation. 2. Understanding risk and goals. 3. The investment menu. 4. Core investing strategies. 5. The magic of compounding. And finally, 6. Maintenance and learning. Starting off with Section 1, your financial foundation. Just like building a physical house, you absolutely cannot construct a sturdy structure without a solid base, right? Before you invest a single dollar into the market, you have to understand your current financial situation and take total control of it. There are 2 critical first steps here. Number 1, secure a stable source of income. And number 2, build an emergency fund that can comfortably cover at least 3 to 6 months of your living expenses. Doing this puts you directly in the driver's seat of your immediate financial life. Now, why is that chunk of emergency cash so absolutely crucial? Because it acts as your financial safety net. It's basically your armor. When the market inevitably dips, and it will, or you face a sudden personal expense, having this cash on hand prevents you from panic selling your investments at a loss. It essentially buys you the peace of mind to just let your investments keep working for you completely undisturbed. Moving on to part 2, understanding risk and goals. Before laying down any bricks, you really have to ask yourself, what are you actually investing for? Common goals include things like saving for retirement, buying a house, funding your kids' education, building passive income, or achieving total financial freedom. Identifying your specific personal goal is critical here, mostly because it completely dictates the best investment strategy for you moving forward. Hand in hand with your goals is your risk tolerance. This is a bit of industry jargon, but it simply means how comfortable you are with market fluctuations, the unpredictable ups and downs. To put that into perspective, younger investors with a long time horizon can typically take on way more risk because they have decades to ride out and recover from market downturns. On the flip side of that, older investors approaching retirement age might strongly prefer safer investments that preserve their existing capital. Let's look at part 3, the investment menu. Now, what's really interesting about this slide is how we can systematically categorize these assets. Distinct purposes quickly emerge. For conservative investors, high-yield savings and bonds offer lower risk and lower returns, which is pretty much perfect for preserving capital. For long-term wealth creation, index funds and stocks offer medium to high risk, but historically they have strong returns, letting you own pieces of real growing companies. Then, for the higher risk opportunities, cryptocurrencies offer extreme volatility, meaning they should probably only make up a tiny, small portion of your portfolio. Finally, gold acts as a hedge asset. It helps preserve your purchasing power during inflation, though it's important to note it doesn't generate any cash flow on its own. Another incredibly powerful material for your portfolio is real estate. Property investments provide excellent diversification by generating steady rental income and generally appreciating in value over time. However, it contrasts pretty sharply with stocks because it requires significant upfront capital, ongoing maintenance, and let's be honest, the heavy lifting of careful property management. That brings us to part 4, core investing strategies. So how do we actually build our primary defense mechanism? Well, the absolute key to successful investing is diversification. You must never, ever put all your money into a single investment. By spreading your investments across multiple asset classes, different industries, and various regions, you drastically reduce your overall risk and significantly increase the stability of your portfolio. It's essential. Another totally brilliant technique is dollar cost averaging. Instead of obsessing over the daily news cycle and trying to perfectly predict market highs and lows, which is almost impossible, you simply invest a set amount consistently, every single month. This inherently simplifies the whole investing process. It automatically allows you to buy more shares when prices are low and fewer shares when prices are high, smoothly averaging out the impact of market volatility over time. There is such a critical behavioral contrast here. The emotional investor sells in a panic during crashes and blindly chases assets after they've already skyrocketed. But the successful investor? They rely entirely on patience. They understand that markets naturally rise and fall. It's just what they do. They remain fiercely focused on their long-term goals and just continue investing their money through both the good and the bad periods with unwavering discipline. Let's get into part 5, the magic of compounding. And this brilliantly illustrates the secret ingredient that transforms consistent, everyday effort into massive wealth: compound growth. It happens when your investments generate returns, and then, here's the kicker, those returns generate additional returns of their own. Over time, your wealth stops growing in a straight, predictable line and begins to grow exponentially. It's like a snowball rolling down a hill. The earlier you start investing, the more exponentially powerful this magic becomes. I want you to just imagine investing consistently for 20 to 30 years. When you combine regular monthly investing with compound growth, time literally becomes your greatest asset. In fact, if you just invested the cost of a daily cup of coffee into a historic index fund, it can mathematically grow into hundreds of thousands of dollars over a few decades. Seriously, time does the heavy lifting for you. So the crucial point here is captured perfectly in this famous quote from financial experts. Time in the market is more important than timing the market. Patience and time are your absolute ultimate wealth-building tools. You don't need a crystal ball to be successful. You just need to start and stay put. Finally, part 6, maintenance and learning. Your portfolio does require a bit of ongoing maintenance. You need to periodically review your assets. For instance, if your stocks grow significantly and suddenly take up a way larger percentage of your portfolio than you originally intended, you do something called rebalancing. You sell some of those overgrown assets to buy others, which brings your risk profile right back in check. Additionally, you've got to continuously learn, study financial markets, read up, and understand broad economic trends to constantly upgrade your financial knowledge. Let's quickly summarize the core message from our sources today. Investing is absolutely not an overnight get-rich-quick scheme. It just isn't. It is an intelligent, long-term journey of risk management, extreme patience, and steady growth. By establishing a really solid foundation, selecting the right instruments from the menu, diversifying your assets, and letting compound interest do its thing, you are paving a very real, mathematical road toward lasting financial independence. Which brings us right to our final question for you. The blueprint is laid out right in front of you. Are you ready to build your foundation today and let time do the heavy lifting for your financial freedom? Remember, the sooner you take that very first step, the sooner the magic actually begins. Thanks so much for joining me on this Explainer Focus Learners, and I'll see you in the next one.